Hey everybody, I'm Mike Desepoli and welcome to the Heritage Market Pulse for Friday, October 8th, 2021. We hope you had a great week. We're here to wrap up the action for the markets this week, talk with you about a couple things that caught our eye, things that we see that are important in this market, and why we are stronger and firmer than ever in our beliefs that this market is headed higher into the year end. First, let's talk about the big news of the day, the monthly jobs report, data from the month of September for the labor markets. The expectation was for an increase of 500,000 jobs. However, the headline number was a big miss, showing an increase of just 194,000 jobs. Now, I'm going to tell you why we believe that this is very important and how it fuels or feeds into the greater narrative, one of the things that's been hanging over the market recently. So a number like this, when you look at a number like this, now naturally we want to see job growth. We certainly want to see people back to work. The higher the number, the better. But in our job and in our view, a number like this does a couple things that are very important. Now, the first thing it does is it puts the Federal Reserve on hold. Okay, concerns about if they were going to move to alter policy, maybe get a little bit more restrictive, that would have been reaffirmed if this jobs number had come in well above expectations, right? It would have given the Fed essentially the green light to say, look, this economy is doing fantastic. It's time for us to take our foot off the gas. However, a number like this where, yes, we saw growth, but lower than expected trend, will give the Fed a little bit of a pause and say, you know what, we probably want to wait and see one more month, maybe 2 more months of jobs data before we'll make any adjustments. So that's why we think it's very important, because it fuels, or actually I shouldn't say it fuels the narrative, it removes the narrative that the Fed is going to act swiftly to stop this market in its tracks. So that's something we think is very important and we wanted to talk about today. We've been seeing a lot of stuff coming out of Washington, D.C. that's hanging over this market, that's pulling down, dragging down this market about 2 main things, right? The debt ceiling resolution battle and Biden's desired spending package. So the the Senate has passed the debt ceiling resolution. We've seen some relief come into the markets ever since that has passed, I think about 36 hours ago at this point. And now the House will vote next, but it looks like it'll pass there. What they did was basically kick the can down the road, extend the deadline to December 18th when we get to do all this all over again, right? So this is how governments work, right? We prolong these problems. Eventually they'll get a longer term deal in place, but nonetheless, one less thing for the markets to worry about. The attention now will focus on Biden's desired infrastructure package, what the size of that package will be. All indications right now point to the fact that a $3.5 trillion package is not going to get through at that size. Likely we'll see something smaller, but remains to be seen some of the finer points of that deal and how they will negotiate that. We want to bring attention to some seasonality trends again, right? We've been talking about this for a while. You know, they always say that maybe history doesn't repeat itself, but it certainly can rhyme. To this right here, I'm going to put up a chart. You're looking at the S&P 500. This is the broad market index, and we're looking at the last, call it 14 months or so. And what we want to point your attention to is the fact that the patterns that are unfolding right now from September into October look very similar to the patterns that unfolded last year in September and October. And what these markets succeed in doing when they have these types of consolidation and choppy patterns is convincing the herds that this market run is over and that it's time to take their money and walk away. And then what happens next? If it looks like last year, the market will go on a very parabolic move higher, and many investors will be kicking themselves because they missed it. So again, not here, not now, and not our investors, but we want to point that out to you because this is the type of market activity we see every year in the fall, and every year there might be a different reason or problem hanging over the market. Last year it was the election, this year it's debt ceiling and congressional battles, but nonetheless the market has a way of lulling people to sleep, convincing them this is not for them before starting another move higher. So we expect that to happen here. And we think that all the chips are aligned in the right way in order for this to play out. We will obviously be watching very closely as we move now into earnings season. We want to make sure that the growth in corporate profits is still there, because as we've told you many times, we think the 2 main catalysts for any equity market are corporate profits and global liquidity. And as of right now, we still think that both are continuing to expand. So that's all we have here for today. We hope you got value out of this. If you have any questions, reach out to us. We're always here to talk to you about the things that matter with your money. We hope you enjoy your Friday. Have a great weekend, and we will see you back on Monday for the Heritage Market Minute.